Hey, what's
So,
up, everybody? It's Mike Norman, and we're here with another podcast with one of my most favorite guests. He is a contributor to Mike Norman Blogspot, Mike Norman Economics Blogspot, and an avid reader of MMT Trader. And also, I always refer to him as my really smart friend
yeah,
because he comes up with these angles that nobody thought about before. I mean, this goes way back to when we started talking I guess it was like 2019 when the Fed doing QT ran the reserve level down below the required threshold of what banks needed to hold, basically putting the whole system potentially into insolvency. I mean, you were the guy who pointed that out. So let's get right into it. All right, let's start off. We'll start off with the obvious news that's been happening for the last couple of weeks with these crazy, bank failures. Starting off with SVB. Somebody asked me a question, and I'll put it to you. If SVB suddenly had a run, why couldn't they just borrow reserves in the system or go to the Fed's discount window to cover that? There shouldn't have been a run anyway if the Fed was doing its job, because that was basically one of the fundamental reasons that the Federal Reserve Act was created, right? I mean, it was there to maintain stability of the financial system. Then we got into all this other crazy stuff, like you have to keeping an employment level, things that they're not even capable of doing. But anyway, what's your take on why SVB wasn't able to access reserves?
well, I think what might have happened, there has to be a very detailed investigation into what transpired. Apparently, they got some unanticipated withdrawal requests that they didn't have the reserves, the ready reserves to settle. So then that created a liquidation. Like you say, why couldn't they go to the Fed with what they had? I think they eventually did that,
I mean, there's
but
plenty of reserves in
maybe
the system, right? There's like well, after
eight
last week,
trillion
it's
or
like
whatever.
3.4 trillion,
Oh
and
yeah,
then you
yeah.
got what's in the RRP. But anyway,
Well, well, it seemed like what happened a couple years ago when they did that, they kind of had that mistake in September of 2019. I think in some kind of a knee jerk response to that, they lowered the reserve requirement from 10% to zero.
right.
Okay. Now, no one's ever asked them why that just went through. That was just put out at some kind of press release. It never was, questioned. I don't think I've never heard anybody asking them like why they did that. Um, it seemed like to me to require a depository to have 10% of its assets in direct central bank liabilities, which I guess that's what reserve balances are to a depository. What I don't think that's an unreasonable. It's a small percentage, and it just provides a little cushion that if the bank does receive some unanticipated withdrawal requests, they would have non-term, non-duration assets that U.S. dollar assets that they could use to settle those withdrawals. So I don't know why they did that, why they went from 10% to zero. It seemed like they did make that mistake. Maybe they overreacted, just said like, well, we'll just make it zero so that never happens
Well, I
again.
think
You know,
Canada doesn't have a reserve ratio, and I think that speaks to the fact that that's why you have a central bank, because if the situation arises where you need those reserves, first of all, banks have regulated assets that are already pre-approved by the government that they can post as collateral. I remember back in 2008 with the Lehman thing, Bernanke was only initially taking, the highest rated collateral, which was basically treasuries, when all of the collateral held by the banks, some had bigger haircuts than others. Obviously, treasuries, you get like basically a face value 100% on maybe it has a slight haircut. I don't know, a 0.5% or 1%, but he wouldn't take that at first, and then eventually, when the whole thing started to go down the drain, then they lent on an unconditional basis against all
Well,
collateral.
well,
But
what?
I know you said for a long time, and I want you to explain this, that that was the reason for the crash, that they pumped in so much reserves so quickly that it literally put the banks in a situation where they had a lack of capital for the amount of assets that were suddenly put on their books.
Well, yeah, you remember they did in the summer of 2008. They did that $650 fiscal payment to all taxpayers to try to, because the economy was kind of slowing down. It was getting like some tepid economic growth. It was going into an election year, or it wasn't an election year. I think GOP typically, they want the economy to be robust into their election. So they sent those $650 checks out. It seemed to help, but then I guess it got too close to the election, and I think the central bank thought, well, we'll increase reserve balances so they have more money to lend out. In this, it's like I call it I think it's called a reification error. Like they think money is real, and that you can run out of it, or you can provide it, just like I don't know, like a commodity or something.
Yeah, yeah,
Where it's not, it's well, money is a figure of speech. USD is the unit, the abstract unit, and it exists in accounting constructs and
yeah.
diagrams,
It's not lent out in the form of, if it's lent out, it could be lent out overnight to other financial institutions within the system. I mean, the reserves sit on the Fed's books, as electronic bookkeeping entries, as you say.
right.
But it's crazy to me how this notion. I remember talking to a guy who ran a bank when I was still at Fox News, and I asked him flat out, "Do you lend out reserves?" And he's like, "No, we don't lend out reserves." But yet this is a commonly held notion. I just watched something the other day on YouTube. Was this guy? I think he maybe runs a small bank himself out in Northern California. He says, "Well, we take in deposits and we lend them out." That's
Yeah.
exactly. It doesn't happen that way.
I was doing some looking into this last week, and I came across a note on the internet, a PDF file from one of the major money center banks. I won't say which one. I'll send it to you later. But they have an analyst talking about the situation, and it says something, in there. He says the deposits were not being lent out, or the deposit, we get the deposits and then they were lending them out. He refers to that instead of lending the reserves. It's the other one
Right.
is they lend the deposits or something, where they don't, like, unless you really get some decent training in accounting and finance, you're gonna talk that way, because you
Can't
don't
you
really understand the professional
you
terminology.
can't even lend out deposits if you wanted to, because it wouldn't change the aggregate amount of deposits in the system.
System.
It
Yeah.
would just go from bank A to bank B. So, like,
Yeah.
if there's a shortage of deposits, or if they wanted to lend it out, then it's just a subtraction from one bank in addition to another bank. There's no net increase. The increase actually comes from making the loan. Even if the
Right.
Fed, we've gone through this a million times, and
Yeah,
obviously
loans an asset and the
loans,
deposits
it's not
liability.
like you go into a bank and you apply for the loan, and you sit down with the loan officer, and you get approved based on your credit. He doesn't pick up the phone and call the reserve desk. "Hey, do we have enough reserves here to lend to Matt?" No, I mean, it doesn't happen that way. They make the loan,
Well,
and if they don't have enough reserves, they get an automatic overdraft at their account at the Fed, which the Fed covers. That's where the reserves come from.
what's to say that with this thing where they went from 10% to 0%, that these banks didn't just lay off, but you're saying like he doesn't call the reserve manager. Well, if reserve requirements 0%, why would you employ reserve managers? So
Yeah,
so so they could have just canned everybody, that was doing that. So then when they needed, so then they got all these unanticipated withdrawal requests, and then there was like nobody there to like they they saved money and they laid everybody off, and then there was nobody there to manage that because
But
they didn't need him anymore. Like why like Mike, I wouldn't doubt it. Like even right now, SVP, hold on.
SVB.
SVB is advertising a a money market fund that's paying 4.5%. Where I think they're going to the RR. They could have this money market fund, and they could go to the RRP or buy short-term treasuries and then put their people in that. And what's to say like these depositors at SVB didn't see that and say, "Hey, we're only getting like 2% in this bank account. Could
Yeah,
you can you move us over to the money market, and then we could earn like 4%?" And then they did that and bankrupted their bank, like
yeah,
by just because they don't understand it. They would say, "Oh yeah, we could." They would talk to their client and say, "Oh yeah, we can do that. We'll just move the money over there." And they don't understand the regulatory accounting that trying to do that would actually put them in violation of their capital requirement or something. So I don't. This thing really needs to be run down. I think there's a lot of there's regulatory issues that need to be addressed. There's competency at that bank. I think you'd want to look at. Did they lay their people off that would normally do reserve management? Because it seemed like after the fact, now the Fed has created this new facility. I don't know what
yeah.
they call it, and now they're saying, well, look, we'll accept redemption value 100 cents on the dollar against Treasury securities, and you could come in here and you can get reserves
You talking about the RRP or a brand new facility?
of that brand new facility. Like
Oh, okay.
they're taking, and that thing went up, and reserves have increased, so people are accessing, and like you say, it just moves from one bank to the other. So I think systemically, it's not a system problem, but it could affect individual
And
institutions
I
that,
said
and
that
I think that's
from the
happening.
get-go. I said this is not a systemic issue, and
Yeah,
that for a week that's all we heard, and how it was going to snowball. And you said the same thing. I think you agreed with me and
yeah,
you were starting actually to cite comments from people who originally were saying, "Hey, this is going into a systemic issue," and now it's like, "Nah, we don't think so anymore." But this is, to me, Matt, this is a big part of the problem is the way the financial media and the so-called, the very serious people on Wall Street who are not serious at all and they're dumb, how they create these problems out of sheer ignorance, or I don't know, maybe it's an agenda. I tend to think it's not an agenda because that
no, no,
for me it gives them
no.
too much credit.
It's
It gives
yeah,
them it gives them too much brains.
no, they
But
they don't. This is it's a competence issue. It's they're well. It's funny, like politically on the left, they think it's like a big neoliberal conspiracy or something. Like these people know what they're doing when all this shit hits the fan. And then on the right, they're thinking like they'll say, "Oh, this is all like a communist takeover or something." Like this is supposed to blow it up. This is what they want or something. Like nobody wants this. I mean, everyone's trying to like do business and do their job and whatever they're doing, build a house, finance a
yeah,
house, sell a car,
and actually the economy is doing very well. I mean,
yeah,
remember, we came into this year like predictions in the fourth quarter of 2022 universally saying we're going into a recession. I was one of the few, I think maybe the only, you were with me on this, saying there's not going to be any recession because you and I were looking at the fiscal flows, and we acknowledged and we realized that in 2022, it's kind of a funny, almost a comical thing to talk about. Like the White House was cheering a 2 trillion reduction in the deficit, which is a net subtraction of the financial balances of the economy by 2 trillion. And they were like, yeah, that's the biggest in history. No kidding. We had 2 quarters of negative growth. When you drain that amount of, financial balances from the system, it took time then for it to stabilize, which we knew that was going to happen. And then in October, and
Yeah.
you see my
October,
report,
October, October.
every week. You saw the bottom, and it started to turn and accelerate up now.
Yeah, I think October was the point where like the interest rate effect of lowering the present value of financial assets
Right, we called it
kind of
the inflection point.
peaked. It peaked. And now, like, the interest flow is creating a positive fiscal effect, which I think is starting to help. It's starting to be stimulative. It's distributed towards the saver cohort who has US dollar savings. They're benefiting.
Oh,
Borrowers are getting screwed. I mean,
I,
borrowers, their payments are doubled,
yeah.
from.
But on that point, I don't know if you watched my interview with Louis Borsellino, the trader from the CME,
Hmm.
and he talked about the time like it was 1980 or 1981 when rates were 21%. He sold his mom's house. His father was actually murdered, and he they had no money. He sold his mom's house for 250,000, and she was getting like 20% interest on that, and that paid all her bills.
Bills.
So
Yeah.
that's the flip side of the whole. I talk about this all the time, that everything is a redistribution. I don't care if you're talking about interest rates going up or interest rates going down. I don't care if you're talking about inflation. I don't care if you're talking about deflation. It's a redistribution. And the only thing that we should really be concerned about is whether or not there's a net outflow to some sector, let's say the foreign sector, or let's say to the government sector, to the public sector, where that net outflow from our balances goes into the black hole of taxes and are not like redistributed back out. We have taxes, what, 4 times a year or maybe five or something. We got them coming up in April again. It
Mhm.
sucks. Everybody knows it sucks. Nobody likes paying taxes. And I think there's a statistics. I don't know. We work 3 or 4 months out of the year just to pay the taxes, but they're recycled back in. They're spent back in because the government runs deficits. So yeah, we
Sure.
pay it in, and it's no look. I'm not saying, hey, this is a great thing. We hate paying it, but the fact of the matter is, and I use the swimming pool analogy. It flows right back into the swimming pool. After a certain period of time, you're back up at that level and above that level.
Yeah, sure. That's the way these numismatic systems seem to work, where it's like a government, uh, these it's like from the MMT, where they say, it's based, the currency gets its value because of like taxation. People have to pay their taxes in it. So then it becomes convenient to, operate with using those units of the US dollar. The cryptos are coming in, and that's kind of like fringe still. I'm not sure where that's going, but the dollar system, and it is probably, it goes around the world. Like a lot of countries are using it, and they're all trying to get US dollars.
Well, some are, some are, and I've always felt, when crypto emerged, I felt that it was a manifestation of Washington's increasing kind of weaponization. I call it the weaponization of the dollar through sanctions and shutting entities, whether those be commercial entities or entire countries, out of the dollar system. And so I thought that's a natural reaction to try to find an alternative.
Alternative.
It didn't mean that it would, like, Bitcoin was going to become the new thing. It's probably like something, an intermediary step until who knows where we're going to end up. But I didn't see that as like becoming a dominant thing. I saw that more as a reaction to the greater and greater weaponization of the dollar, and Washington's desire as a foreign policy tool, and
Yeah, they
almost
can.
almost a military tool to shut people out of the system. And now we're
Yeah, they.
starting to see a lot of this disruption now is because the global trade system, which basically has been in existence, let's say the modern version of the global trade system with the WTO since like the 1970s, that's all being broken up now. I mean, we got new
Yeah,
trading blocks, like a whole new evolution is happening there. And that's going to take a while to play out, but you could start to see that play out.
yeah. It seems like that Bitcoin one is the one that has some staying power
Yeah,
because
that's what I always thought too. You had a
and
lot of crazy ones like the doggy
Go
coin,
coin and different things. I don't know. I can't. I don't really. I mean, I
Ethereum.
follow Ethereum, but Ripple, uh, whatever. But they. I mean, Bitcoin's gone up. I mean, recently it was like 16,000, and I think the other day it hit like 28,000.
Yeah,
I
yeah,
mean,
yeah, yeah.
it's
But
like a 50% gain, and
but
while all
listen,
this hell,
Matt, and I will state, and I think I have even made some comments about this, that Bitcoin is following the fiscal flows.
yeah,
Like
it
you
is,
could
it
you
is,
could
it is.
literally look at the bottom of Bitcoin. It also bottomed around the time of
Time,
that
yeah,
October bottom.
absolutely, yep,
And
yep,
so, like, it's more like a growth indicator, right? And that's I
and tech.
same thing
I
about gold. You could look at gold. I mean, now look, gold is going up. Why? Because we have this very nice, trend of fiscal expansion going back up, and so everyone's like, "Oh, gold is this inflation hedge, right?" It did terribly, over the
yeah,
last year and a
right.
half when we had inflation that everybody said was the worst since the 1970s.
Yeah, it
It was terrible
fell a
because
thousand bucks or
we
something.
had a 2 trillion contraction in
Yeah,
financial balances
flow.
of the economy.
Right, right. But with the other thing is it follows is tech. Well, because I follow the Nasdaq 100 a lot, and that's making. I think today, Mike, it might be making a new high, like a post October high.
Yeah, yeah.
Today, if well, it kind of fell with all this banking thing, but it's rallied. It's making a 30-day high for
Well,
sure, and
let's
that's
just
within.
let's zip it for now because we're gonna put the kibosh because the Fed is coming up in another 40 minutes or
Well,
35
well,
minutes.
well, but
What
what
do you
it
think they're gonna do today, Matt? What do you think they're gonna do
I,
today?
I think a quarter point, and then maybe say something that they're going to stop for a while. Like I think that's what I think they're going to do because they're. I think that this Larry Summers guy has a lot of like an influence in the Biden administration, and I think he came out and said something like that the other day. Like you got to maintain. They want, this is the playbook to fight inflation, and I think even in Powell's testimony a few weeks ago, he got into it with Senator Warren, who was taking more of a left wing position, was saying like, well, what about the people? What about the people that are borrowing money and yada yada yada? And Powell got back in her face and said, well, look, well, do you think that this inflation is good for them either? Like they're not. That's just as bad as what you're talking about. So I think they're true believers that they think this so-called inflation is bad and they have to be seen as trying to do something about it. And I think they're going to go, they're going to try, they're going to, they're going to go another quarter
Well, it
because
looks
you don't.
that way. I'm looking right now at the Fed Watch tool, which is basically looks at where Fed fund
Mhm.
futures are trading and then estimates the probability of what the policy rate will be. And right now, we're looking at about an 86% chance of a 25 basis point hike, in another half an hour, and about a 14% chance of nothing.
of
And
nothing.
there's a 0% chance of a
So of a
50.
half.
And
Yeah.
and so like one thing we know about Powell, and you and I have talked about this, is that this guy is just a slave to the market. I mean, I've never seen anything like it. And
Yeah. So you're saying the market's saying highest probability is 0.25. So that's probably what they're going
yeah.
to do.
I mean,
Yeah.
if
Okay.
Powell, listen, I'll say this, and I said this yesterday on my on my video. If Powell holds at 4.5, 4.75 where we are right now, that would be the first time he showed any balls or any like kind of leadership since his tenure. And what, he's into his second tenure as the Fed chair. I mean, that would be, and by the way, if that happens, I will make this prediction. The markets will go crazy. Stocks will go up, gold will go up, the dollar will go down, commodities will go up. And I'm not so sure how bonds will take it. They might rally at first, but then people might start to hit them with, oh, you're just going to keep that whole inflation thing going.
Well, before all this banking thing, like of last week, where all of the big money center banks were out saying 6%. Like I think JPM started it saying like, well, we could go to 6%, then Bank of America said it, Wells. I mean, they all started coming out and saying, yeah, 6% would be okay.
But
So
I
they're probably
think,
positioned. They have no problem with that. They're
yeah, but
positioned.
they're loving it because
Yeah,
they hold most of the reserves in the system. Those big banks you're talking about, Jamie Dimon
yeah.
and Wells Fargo and Citi and Bank of America, right? And
Well, they're
they're getting paid 6% by the Fed. They're just the Fed sending them checks like free money. Here you
well,
go.
well, right. And if you look at residual, like if you look at system residual, it bottomed in October,
Right.
and now it's come down off its recent high a little bit, but
It's
but
not
but
down
it's
that much.
still higher than it was by, I don't know, $100 billion. Like the
100,
Fed.
114 billion higher than when the Fed started raising rates. And I just looked at this the other day. It's only down 1.8% from its high, which I think was in April 2022. So it's not like, that's another thing. And it was another argument that I used to say, you know what? This whole banking system collapse, systemic collapse, whatever. Like there's plenty of capital in these banks are well. Now you might be able to pick out a few of the smaller ones and the regional ones or whatever, but listen, I mentioned earlier that I don't think this is some kind of like a secret conspiracy going on, but it might be if you consider that you got guys like Jamie Dimon. They want to scoop up all these assets, don't you
Yeah.
think?
Well, yeah, they're that would be helpful to them. But even if you're like, there was a media report that said on Thursday, I think the 9th, that SVB was faced with $42 billion worth of withdrawal requests. So even if they were a $200 billion bank, and if they're required to keep around, even like say it's 10-1 capital, they have 20 billion of capital, A minus L equals C. So their assets would be 200 billion, liabilities would be 180, and then their capital would be 20. How, I guess, like if their depositors come in and say, hey, we want $42 billion, what are they going to do? Like I don't, I guess they could pledge their assets to get reserves, and then they would just be kind of like a zombie bank until they could get those liabilities settled with the Fed. But they wouldn't have to resolve them, but they wouldn't be doing a lot of good business. But it would be really bad. These large withdrawals are bad for these small banks. I don't think, especially if the government would respond to close them down, and then all the equity holders, any equity is gone. They would just make, the stock would go to zero, and then they would try to get everybody whole that had liabilities with them. But even that's, the government has limited ability to do that.
Aren't they talking about, I heard something that they're talking about trying to come up with a plan to guarantee all deposits now. Have you heard that?
Yeah, yeah. I mean, I think, well, like you say, it just moves to another bank. Like
Yeah.
when they say like it doesn't like the way you say
Right.
it doesn't fly off into outer
In outer
space.
space. Doesn't fly out into outer space. It
It
all
doesn't.
stays in the system, man.
Yeah, it doesn't. Well, they think it's real and that it can fly off into outer space. I mean,
Yeah.
I don't know how else to explain it. They have major cognitive problems, but they it just will move to another place. So if you look at anyone who had a liability with SVB, if they say, well, now we're going to move you over here and your liability is going to be with JP Morgan, that person's not going to be, pissed off or whatever. They could just move them over there. But it really shouldn't have to happen in the first place. If the system is being administered and regulated properly, I still think that they went. Mike, look, they run reserves below their own 10% thing.
I mean,
And then
how does that happen? That's like somebody's that really talk about
well,
being asleep at the
it,
wheel. You and I were the only one. Like we brought this up in 2019 when it was happening, and we said like, holy crap, there was like I don't know 13 trillion in deposits, and
deposits
then
at that time.
they went down to like 1.2 trillion in
Yeah, yeah,
reserves, which was below the 10% their own
right,
ratio.
right. And then they were trying to quote normalize. They were at that time they were trying to reduce system reserves to sort of like normalize reserves because I don't know, they ran them up at the beginning of the well, they ran them up when they were doing all that quantitative easing throughout like the Obama administrations, and then they started to reduce them under like around the Trump time, trying to normalize things, but they went too far. And they did a survey. You mentioned it numerous times where they went out to the depositories and said, "Well, what do you think total system reserve should
Yeah,
be?" And they
yeah,
were saying like, "Well, around 600, 700
billion.
billion."
Yeah,
So maybe at that time there was 8 or 9 trillion of system deposits, but then so they're going like, well, maybe we'll go down to that. But meanwhile, deposits are 13 trillion and you got a 10% requirement. So you
yeah,
need to make sure that that system has at least 1.3 trillion of reserves, or else
yeah,
no one can meet the
yeah.
requirement. But then, so of course, they went below that, went, so the way they explained it is they go, liquidity dried up. Like what? Like where,
What?
they use like figures of speech and
Yeah,
they go, liquidity dried up. Oh, must have dried up or something. Like what? And then we're like looking at the reports, their own reports, the H8 report and
right.
the H41 thing, and we're saying like, hey, they've got reserves at depositories right at like 12.85, and there's over 13
Right, right.
of reserves. So then they go, Mike, like say you go to Jones Beach, right?
Yeah,
And you go there in the summer, you're gonna have a nice beach day, and you forget your sunblock, right? So you go out there and you get a sunburn. You forgot your SPF, and you get a sunburn that day or something. So what do, Mike? You go home and say, I'm never going to the beach again. Like, or do you say, well, I gotta next time I go, I gotta remember to bring my sunblock. Like they did like this knee jerk thing. Say, well, we'll just lower it to 0%, so that'll never happen again. I mean, it's like this immature, petulant. I don't know what the adjective you want to. They're.
No,
What
it's a
what were
kind of
they thinking?
it's a
What?
kind of a it's a kind of a warped orthodoxy, and I've spoken about this many times. That look, this is a very elite club. Like if you're in a
Right.
central bank or if you're at a high level policy position, that's an elite club. And you can only get into an elite club if you are aligned with the orthodoxy. And unfortunately, basically the last 50 years, 45, 50 years, we've been under this, the rule of monetarism, that to the point where I hope that fucking Milton Friedman is burning in hell right now but I mean, like, and it just seems to be coming more and more like ingrained and intensified, and it's gotten to the point I call it a psychosis because it has gone from being, let's say, a policy to now basically being a mental illness where you just have these thoughts which you cannot get out of your head. I'm not a
Well, well,
psychologist, but
well,
it's a
well,
psychosis. It's a
it's what
mental illness.
it's what they believe. So they're gonna, and it's what they were taught. So if you took a course in I don't know, whatever this would be covered under, some sort of economics or macroeconomics or something, and this is what they taught you, then that's what you're going to believe. I can't really hold them accountable because everybody was a young person at one time and was subject to the academic, process, and that you're taught stuff, and it's a high stress environment, and you get through it. You study, you prove, you take tests, you get graded, and all that stuff, and they're not. This is what they're being taught, and whereas if you would take, you wouldn't take that. Maybe you'd take like finance and accounting. You're like a number cruncher, and you're trying to, you understand those diagrams, those abstractions, like a balance sheet, an income statement, and all that stuff, net present value of financial assets. They don't have that. These people are all like, if you look at their background, they have like what's his name? Larry Kudlow was like the CEA. He has like a history degree
Yes,
from
yes, yeah.
Princeton or
He's
something.
not an economist, but
So
neither was Greenspan. He was a saxophone player. He was a musician.
right,
You know,
right. So I
he was
it's not
like,
it's not the right background. Like even Jay Powell, he's a securities lawyer, so that probably has some value in his position because there are legalities involved in securities and things like that.
but
So
but
he
that's
he
that's more. I would say that's more a technical understanding the legalities as opposed to really having a macro understanding. And again,
yeah.
you're not going to become the Fed chairman if you're talking about like MMT or something like that. If you're talking
No,
about
no, no.
anything outside that orthodoxy.
Well, it
But
used to be like a banker. Remember, like these people were like banking people, and then all of a sudden they went over to these like academic economists.
yeah,
I guess Greenspan might have been maybe the first one, and then it was like Yellen and who I don't know who else was in there, but Bernanke, he was an academic economist, and then I think they should get back to a banker, because those people might understand. Like when they make a policy change, you have to think ahead on how that's going to affect.
the last banker, I think I forget his name, but he was after Arthur Burns in the 70s. He was in a brief time there before Volcker came in, but I think he was a banker. But
Yeah, they have to have some experience with the system, with the system that they're trying to administer, and that I don't and so like you saying, well, like where all this monetarism come from in these central bank and economic policy, it comes from these people, because the head guys there and gals have been academic economists, and they're not. To me, it's an inappropriate training. It's an
well, you call him.
inappropriate
I
background.
love it because on the blog, you refer to them as art degree morons, which I think
Well,
it makes me crack up. Some people get
look,
pissed off at you, but here's
look,
the thing:
Mike.
like any credible science, and I've said this a million times, and it's irrefutable. Any credible science would go back and re-examine their theses if it was not showing up in the empirical evidence. They would say,
Right,
something's not
something's
wrong.
wrong.
Something's there. This is the only, and they believe me, these guys consider themselves like at a science level academically. All right. And they're just like, they ignore that. They ignore that completely.
Well, look, I love art. I don't do it. I mean, I love music. I love motion pictures. I love
Same here, man.
Netflix and stuff. I like sports, which is a performance art. I love all that stuff, and I don't really do it. But I'm not. You know, if you told me to go do that, no one no one would ever watch it. It would be terrible. You could say like, hey, you're a STEM moron, and I would be. I mean, I'm not. I'm just saying. I respect those people for what they should be doing, but they're really out of position in this situation. They're not. They don't have the training, the proper training for management and administration of a numismatic system.
And,
They
and
have.
it seems like now every iteration of new policy is like this crazy addition to some kind of Rube Goldberg like weird system. Like, when they were doing all this QE and they were piling trillions on bank balance sheets to the point where the banks were now, they either had to raise more capital or slow down the lending rate or sell off assets.
Or they suspended it. They
Yeah,
suspended it for a
or
year. Remember
suspend
that?
instead of doing that, they said, okay, well, we'll come up with a new facility now where we'll add all these reserves to you, and then you could just give them back to us. Like, it's just
Well,
crazy ridiculous.
and meanwhile, taking the requirement to zero, so all of these other banks that don't really deal with the treasury in the reserve management, like treasury sales or reserve drains. So all these big money center banks that are the primary dealers, all of the reserve balances flowed over to them. So much that they didn't even want them, and they had to kind of shunt
Right.
them into this RRP. But just think about all these other banks like Silicon Valley Bank. What are they doing? They're not involved in that. They're
No.
out there on the West Coast trying to do tech, software, like new technology, financing, the development of these emerging technology corporations. They don't have anything to do with any of this reserve and treasury stuff. But they still want to comply. So they just, so the regulator says, hey, you don't need these things anymore. It's 0%. So they're like, okay, yeah, we don't get involved with that anyways, and we can, they're at the time, Mike. I think the IOR was yielding like 0.01%. Okay, so there's like, well, why do we want these balance? If the regulator says we don't need them and we can get rid of them, they're only yielding 0.01. We could go over here into a 5-year treasury, maybe yielding 2% or something, and get, we have billions of dollars. We could just get that money coming into the bank. So that's what happened. And now you created like this two-tier system where I feel like all of these kind of secondary banks, these regional banks or whatever they are, like community banks and so forth, they're very vulnerable, because the money centers are there provisioned correctly with these balances that they may
Yeah.
need, and the
They're,
other ones aren't.
they're
So
sucking up all the money. Like, if the Fed goes now to 5%, what, with 6 trillion in reserves, so that's three
yeah,
hundred billion a year. 300 billion a year in checks going to like JP Morgan and Citi and Wells, and
the ones that have
that's just an
reserve,
addition to their capital. That's just
yeah,
free money.
yeah, I think the accounting, like if you look at how they would do that, if they were paying them IOR, they would have to pay them in reserve balances so that they would get reserve assets. So their assets would go up, but then there's no corresponding increase in liability
Right,
because it's so that on the right hand side, it would accrue to C. It would accrue to capital
right.
because A minus L equals C. So if A goes up, L stays constant, the C goes up. So and we could see that in the residual because the system
Yeah,
residual has bottomed and is starting to work its way up. It's
right.
just not. It's a distributional thing. Getting back to that, it's not where it needs to be.
Well, the
Those
residual
balances
the
are not.
residual has bottomed because there's been a lot. I think there's been a very large liquidation in securities. They've had to dump out their securities. Um, so that
Even with, I think, remember they used to report at the bottom before they started raising interest rates. Down at the bottom of the H8, it used to say, "Note, what would they say? Unrealized losses on available
right,
for sale
right. They don't
securities."
show that anymore.
They took it out.
Yeah,
Like what's up with that? Why? And that was right before they started raising rates. To me, it's almost like they're embarrassed to publish that or
well,
something.
I
Like
found
like like
you
where
showed me that. You sent me a clip from, I don't know, somebody posted it on Twitter, and I actually I looked it up at the FDIC, and I downloaded the data, and it was like when you combined uh, available for sale securities with held to maturity, it's like negative 620 billion. They hit
Yeah, yeah.
negative 620 billion. And that's the Fed's all doing with this the crazy rate hike cockamamie bullshit that they think, this is going to squash inflation. Look, how many times I mean it should be so clear that
But Mike,
yeah,
doesn't the non-seasonal adjusted residual, doesn't it include that? I got to go back and check, but because even with that, even with that $600 billion loss, I think that's in the
it's in,
residual,
it isn't,
and
it isn't.
and residual is not at a low.
No,
It's bottomed.
it's down
So
2% from its high. That's at 1.8%. I just ran the number yesterday.
somebody's doing okay.
Yeah,
Like somebody, there's assets or something. There's assets there that are well in advance in excess of liabilities to offset that 600. Well, maybe they could remove the liability if they shunt it to the RRP, I think, and then so they could lower L, let A stay constant, then residual can kind of respond. Residual is going to be positive, but I don't see. These are the things where, like in other times, like in March 2020, September 2008, that residual really went down.
yeah,
That's what caused the problem. Is their policy, either the policy reduced residual in proportion to total assets.
yeah,
Both cases. So
yeah.
that's, I mean, look,
And
this
you can
isn't
see that
hard.
on a chart. Like if you take a longer term chart that goes back to that period, I mean, you
Mm-hmm.
could that's a very uh that's a very identifiable dip. This one here has been mild. It's been very mild. That's why again I said I didn't see this as any kind of a systemic problem. I just did not.
No,
And
people. I mean, I think housing sales last month, I think, were okay.
yeah, they jumped
They
up
weren't they weren't
16%.
bad.
Yeah,
And
yeah.
what do you call it? Atlanta Fed, the GDP now. I checked it this morning. It's 3.2. It's for this quarter. So that's not bad. I mean, it's better. There were many years we never did two.
Yeah, I mean
So it's above three,
the
3.2.
average, I think the average has been like around 2.5, maybe slightly above that. So
Right.
and remember, this was the year that universally, not me, not you, but everybody else predicted there was going to be a recession.
A recession. Yeah.
Yeah,
Well, they keep pushing that back. Like what they keep saying. Well, it's going to be in second quarter
yeah,
2023. Now then they said,
yeah,
we're thinking maybe
2024. But
third
see,
quarter,
Matt,
fourth quarter. Now they're into 2024. It's like, well,
that's the only way that they can kind of rationalize, their credibility, which they have none. It's
yeah,
like a guy like Peter Schiff saying, the dollar's going to collapse, or Jim Rogers, he's one of these crazy psychos, or what's Jim Dines or whatever. It's going to happen one day, but
yeah,
well, one day the Earth will stop rotating around the sun too. But I mean, that's useless information when you just keep saying, okay, now we're pushing it off to 2024. I mean, they're just ignoring the data because they're wedded to this kind of outlook that
right.
is all based on everything
Mo-
they see is through monetarism.
Money is real, and we can run out of it. I mean that's their whole. That's if you had to put it in monetarism or phrase, is money is real, and we can run out of it. Out of money. It's buried in a backyard in a coffee can or something. It's not. They're just not competent. They all do it. I mean, it sounds good politically for the politicians to say shit like this, blah blah blah. Like it's like I get a kick out of that guy from Louisiana, that Kennedy or whatever.
Kennedy, oh
He's
my
like
God.
Mr. Haney. He's
Yeah.
like, Well,
Yeah.
well, down, we're down in Louisiana.
Yeah, 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 yeah.
It's just like this corn pone thing, and
Exactly.
and and and
And
and
he
that.
plays that up. He plays
Oh
that
yeah,
up.
yeah, yeah, yeah. They're like, it gets viral. It's just like, hey, look at Kennedy, man. He really let him have it.
And the
It's like,
guy's not
oh no,
the guy's highly educated. I think he's a Harvard law
law,
degree.
yeah. A lot of them, but that's he's sort of out of his lane with finance and accounting. It's not that's not. I don't think having a law degree,
No, yeah.
securities law like Powell, there could be some applicability. Uh, but to try to understand a highly abstract system like an accounting system, you have to really work at that and train in it. Run. I mean, I didn't major in that, but I have, for someone who didn't. I have a lot of training in it, and you run like bookkeeping accounts. You immerse yourself in it. You train in it, and it becomes you have a degree of familiarization where you don't have to rely on this reification, this simpleton.
And
Uh,
now you have like Yellen and Powell coming out with these statements about the debt is unsustainable. The only guy who really understood this was Trump. He said you can't
yeah,
run out.
well,
Like,
but
that kind of went over everybody's head, but he said that in
Mike,
his
everybody else there thinks you can. So I don't know where he's a team of one, because I'm GOP, and I take in a lot of that media, and they would all go
yeah.
like, well, Trump is great, but if I have one complaint against Trump, it would be this debt. The deficit is going way up under Trump, and blah 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 blah. So, and I think Trump's just like drinking like, I got to deal with this. But you know, you know, he's one deep. There's nobody else there. Like if
No,
you
there's
say he
nobody
does,
else there.
there's nobody else behind him that would even understands what he's saying. They probably say like, "Oh, you made a mistake. You shouldn't have said that."
But this kind of bothers me in the respect that, when you and I mean, I got involved with MMT over 20 years ago when I met Mosler, and then you, I think, met me when I had that radio show in Texas. You somehow found it online, and you became interested in it, and it's really kind of burst out into the mainstream in terms of the amount of coverage. But I would say that the coverage is still overwhelmingly negative, that it just hasn't been presented, or people don't understand it, or they don't want to understand it because they're still kind of wedded to this false belief of government as a household, and they're just going to stick.
Well, right, right. Like if monetarism says, if you try to render that down into a statement, they would say money is real and we can run out of it. I think the MMT thesis would be no, money is not real and we cannot run out of it. So that's the disagreement. So how do you settle that? The way they're trying to approach it is through rhetoric, argumentation, like dialogue. They're trying to, they'll write an op-ed, then the other people will write an op-ed, then they'll write a paper, and then they write a paper, and it goes back and forth. And then I think the people are supposed to like look at that and try to figure out what side to believe.
But
Where are we out of money or are we not? I don't know. What do you think? It just becomes this. It's not, where if you say, oh, look, you can't, in science, you can't run out of abstraction, units of abstraction. It's absurd. You can't run out. Like in MMT will say that. It's like points. Can you run out of points on the
on the
scoreboard? Can you
scoreboard,
run
right?
on? Well, they're using like analogy in like your pool thing. That's sort of an analogy, which I guess helps people understand it. Maybe as a first step, where you would say, well, think of it this way. It's like an analogy, but it's really not looking at the, you other than that, you look at the H8 every week, you
Yeah.
look at the H41, you look at the TGA daily. I mean, these are, income statements or ersatz balance sheets. These are abstract diagrams, financial diagrams of what, describing the financial position of all these different entities. So that you have to do that. You have to understand all that. In addition to, like, I don't know. See, the people that I don't really trust are the ones that never talk about any of that. But then all they talk about is and that figures of speech and analogy. It's like the liquidity dried up. It's
Yeah.
it's like what?
It's like a
Okay,
meaningless it's a meaningless statement.
right. So you say like,
You
okay,
can't have an
that's
abstraction dry up.
there's no dry, nothing dried up. I understand that's like if you challenged them, you say like, look, I understand it's like a figure of speech. You're saying liquidity dried up. Okay, there's no pond, there's no real
Right.
pool. It's an analogy. It's figurative language. What happened literally? Like ask them that. What literally happened? And then don't let them answer with another figure of speech. Like they have to tell you in professional terms what the numbers were, what the readings were on these different account balances, what the target ratio was, and you have to go through that. I don't think
It's
any of these people could do that. I
no.
literally don't. I think
It's
they would just say, you would say like the liquidity dried up. Well, what really happened? Well, the tide went out, and then we saw who was naked or some weird like they would go, no. I don't, I got the, I don't need to have another figure of speech. Like what happened?
it's
And can
kind
you
of
just
like it also like explaining the so-called national debt. If you I try to do this by asking questions like you just said, like, okay, who do we owe it to? Okay. And they
yeah.
might say we owe it to China. Okay, what do we owe them? We owe them whatever, 2 trillion or however much they owe. 2 trillion what? $2 trillion. Okay, where did they get the dollars from? Well, they sold us a bunch of stuff. They sold us a bunch of TVs and textiles or electronics or whatever they sold us. And so they've been
They're
paid.
they've been
It's no,
paid.
they've been
What are you
paid.
gonna what are you gonna
And
pay them back?
they're just holding the dollars in another form of a dollar, which is a treasury security that's a dollar equivalent, you know. And
And it's
so
and
like
it,
there
it's
is
it's
no debt. There is no debt.
No, we paid them. I mean,
We
there
paid them.
we have now that the interest rates are non-zero, we owe them interest on that, which is not, I don't know. Some people would say, if I don't want to get into this, where they're perhaps a adversary of the country, a national adversary, and you don't want to be paying your national adversary money, of your currency, but whatever.
But
But
Yellen
but
said they would be the first ones to get paid. Like everyone else could, could go down the tubes. Americans, us,
right,
they're
right.
going to be the first ones to get paid. Like this belief in their heads, like Yellen
All
and
right.
people like
All right.
Yellen,
I see your point. You're saying they're be the first ones to be paid, but you're saying that they've already been paid. I
they've
mean,
already been
what do
paid.
we, right, right,
They've
right.
already been
Yeah.
paid. How
But
many
she's
times?
saying
How
they're
many
going to be the
times are you
first
going to
ones to get
pay them?
paid. How many times are you going to pay
I mean, it's crazy.
them? Well, I don't,
None
I
of
mean,
us
it's
get paid. None of us get paid. How many times are you going to pay these guys?
right. You get paid twice. You're going to pay them again.
Pay them again. Let's pay them again.
I mean,
Everybody, hey,
uh,
Social Security, fuck that. Like we can't. We got to give the Chinese. We got to pay the Chinese again.
we're going to pay them again.
Yeah. So the
Oh,
Fed's
God.
coming up like in a minute. I'm glad this is going to air after that, but we're going to take a
Yeah.
look at what they're going to do. What do you think they're going to do? I'm going to
It's quarter,
go.
quarter, quarter, 0.25. I'm saying.
I'm going to
Yeah.
go. I'm going to say this time, Pal's gonna not do it. I'm
You're
going
saying
with.
zero.
I'm saying
Ooh.
zero. I'm saying he's gonna go with
Ooh.
that 14%. That's a little vote of confidence.
You better be long. What time is
Oh,
it?
I'm long, man.
1:59.
Oh,
Okay.
look at now. It just popped up to 16.6% of a zero. So we're coming up to it. That would be awesome though, man. That would be
Well,
awesome.
there's a lot of bearish people.
Yeah. And I want them to get brutalized. Do you realize this is I've been in this business for so long. I have never seen a period. I have never, here it is, 2 o'clock. Let me see if I can see anything.
I'm looking at Twitter. Oh, yeah. Fed hikes interest rates by 25 basis points to
Okay, there he
5.0.
is.
So I was, yeah.
No balls, pal.
Well, that was, yeah, that was what was sort of the highest thing. Just like you said, they always do
Yeah.
what's sort of priced in. But you have now, I guess you have to wait until the statement. I don't know if that came out
No,
to,
that'll
or
come
if
out.
that,
It's gonna come out in a half an hour.
well, I don't know. Let me see. Hold on. Sometimes it's on the Fed site,
Oh, the
like the
statement.
federal,
Oh yeah,
the
the
statement.
statement. The statement. That's on the Fed site. Let me.
I'll just look at my feed here. Usually one of these people says, despite turmoil in the banking center, yeah, here, FOMC statement, quote, some additional rate increases may be appropriate. This is, I think, basically, this is the Biden people telling them to stay the course. I think they look at inflation
Wow.
as a problem. Plus, all the big banks, they're all positioned for 6% anyway, so you might as well. I don't think it's going to cause a problem for them,
Well, not a
but
big movement, but the market's up a little bit so far. What I'm seeing, it might be delayed on my phone here,
feed.
but
Yeah, let me see. I'm at Yahoo.
oh wow, look at the dollar. The dollar's tanking though, man.
Really? Huh.
Euro's at 108.37. Wow.
My Nasdaq saying up about a 0.5%.
Gold's up
S&P.
about 0.87. I have a gold position. I got out of my forex position.
Well, it's back to status quo. I think the bank thing, you know, maybe they think they have that handled. Like I don't know exactly everything they know, so they might, this whole SVB thing might just be a one-off. They screwed something up there, and they understand what happened. Maybe they understand systemically we're not in big problem. The big banks are telling them, yeah, we're you could go to 6% if you had to. We
I don't
don't
know
care.
about these Silicon Valley guys, Matt. This SVB and this FTX and all these other dudes. Like, what is going on out there, man?
Well, even out there's been a lot of layoffs. So I don't know if that
Yeah.
bank's been doing a lot of loans to some people that have worked at these tech companies that are doing a lot of layoffs. And now, those people, if they get thrown out of their jobs, they can't, maybe they're behind on, some of their mortgage paper could be not going too good and they have to take some markdown there. I mean, that whole tech sector is not, they're doing a lot of cuts, some high profile headcount reductions. Maybe they increased them because of COVID, with people doing a lot inside and going to the online world more during the pandemic. Maybe a lot of that's coming off now, and so they have to lay some people off. But I mean, no, you don't want to see that, but they could be. It might just be something like that going on out there, and some mismanagement, in their reserve position and their, liability matching to deposits and stuff. And, they
Yeah.
could have just screwed it up. Maybe the Fed knows that and says, hey, we're not going to let this spook us off of our inflation. I mean, Powell seemed pretty gung ho on the inflation bandwagon when he spoke to Senator Warren last last time that he was on Capitol Hill a couple weeks ago.
But
She got in his face on the rate increases, and he got back in hers and was saying, look, this inflation isn't good either for these same people you're talking about.
yeah,
Like
but if he was honest, because he was the guy in the beginning who said it was transitory, and
yeah,
there's so much data now that shows it's coming down. You look
yeah,
at
but he,
look at gas prices, natural gas prices. You look at, the used car price thing. There's
oh
so
yeah.
much. I mean, that's what I don't like.
Well, I think
Like
he's
he
being
was saying,
told. I think he's being told this. Like I think his direction. I think he came out with this policy of transitory, and then he was, I think that the administration told him, like, wait a minute, you're not, we got to be seen at least trying to do something on this
Yeah,
inflation.
yeah,
Because
yeah.
it was there's you have it's MMT 101. You have like this big fiscal response in the face of telling everybody to stay home and don't go to work. So you have a collapse in real output coupled with a giant fiscal flow to give people free money. You're going to have a price increases because of that.
Yeah,
It's just like
that's a point that it really riles me up because the critics of MMT said, you see, MMT was they got everything wrong. Actually, they got
no,
it absolutely right because
right,
MMT
Connor,
tells you if
right.
you're going to have a massive fiscal response amid conditions of a global contraction in output, yeah, prices are going to go up. MMT
But
1000% explain that.
yeah, it's elementary to that theory.
Yeah,
So I don't know what people are complaining about. To
just
me it
hate it.
sounded kind of insightful. So I think the problem was with the fiscal response is it was very across the board instead of compensatory. Like there was many people, some people were unaffected by COVID, financially.
Some
Some
people did
people,
really well.
some people did really well. Some people actually gained from it greatly, and then there was other people that got hurt. So they should have just targeted on fiscal response to those in compensatory response who got hurt by it, and then let the other people alone because
Yeah,
their situation didn't change or they benefited from it.
like those
So
those top people on
oh,
the
the Pfizer or
multi-billionaire
whatever.
like
Yeah,
these guys. I mean Bezos and
yeah,
Musk
with
and
the
all.
online
It was
delivery and
crazy,
shop
man.
from home, they all
Made
did
like a
well.
100 billion.
Right. So those they should have figured that out a little better. But I think it was during the Trump administration when they did the original one, and it was an election year, and he's like, I think the GOP general, the bias on the GOP side is to have the best economy you can have going into your November elections. And he just did something that they could do fast, which was like, I don't want to, we can't figure this out. We don't have time. Let's just get it out there.
Yeah,
And
yeah,
and that's what they did. And it didn't really have the initial response, but then the Biden administration came in and did like another 1.9 trillion in like February of 21, and that's when that one was just sort of on top of everything else. And I think it just prices got a little out of control, but it was transitory. Like I think with the if you look at it and you say, well, how do we get the prices down? Well, we with people leaving the workforce, we need to increase productivity, we need to increase efficiency, automation. That requires capital investment.
yeah.
So how is increasing the cost of capital going to help to increase automation
Not to mention the
like
fact that, and things are already starting to ameliorate a little bit, and then the Ukraine situation
oh
and
yeah,
and
that's
the
another one with
sanctions,
energy
the
and the
sanctions that was
sanctions.
just
So all it's just a
shooting yourself in the
confluence.
foot.
Yeah, it's just a confluence of policies that just led to the price indexes going up, and now, I think they're coming down.
Yeah,
As people go back to work and stuff. But it's going to take. I think in the year over year data, I don't think it's going to really roll over until June. June, maybe June year over year. It might be like I don't know 4%, maybe 3 point some
well,
percent.
we might
And
have a problem with energy because we had a big draw. We're starting to see big draws. Today's EIA report, big draw in product, in
mm,
gasoline and distillate, and huge net exports, almost 4 million barrels a day of net exports. But anyway, listen, buddy, we're running
hey,
out of time. We're
all
running
right,
out
sounds
of time.
good.
Great having you, man. I love you, man.
Always good, Mike.
Keep
Love your
keep it
stuff.
going. Keep it going.
Yep.
All right, man.
I'll.
Take it easy, buddy.
All right. Thanks. Have a great day.
Bye, you
Bye,
too.
everybody.